Have you ever wanted to ride the wave of a rising market, but maybe you didn't want to buy the whole surfboard? Well, that's kind of the power of call options. Today, we're going to break down exactly what they are and how they can be a really powerful tool in your trading strategy. So let's dive right in.
So you know that feeling, right? You're looking at a stock and you've just got this gut feeling it's about to take off. But, and this is a big but, maybe you don't want to sink a huge amount of cash into it to get in on the action. And that's exactly where call options come into play. They give you a way to bet on that upward move, but, and this is key, with a built-in safety net.
All right, so first things first, what exactly is an option? Well, it belongs to this family of financial tools called derivatives. Now, I know that word can sound kind of intimidating, but trust me, the basic idea behind it is actually surprisingly simple.
Okay, so the most important thing to get your head around is this. You're not actually buying a piece of the Nifty Index or a share of, say, Reliance. Nope. What you're buying is a contract that's linked to their price. It's a bit like buying a ticket to a concert, right? You don't own the band, but the value of your ticket, well, that totally depends on how popular their music gets.
Now, like any kind of specialized field, options trading has its own language, its own lingo. But don't let that put you off. We're going to break down the key terms you absolutely need to know. Once you get these down, you'll be well on your way to really understanding how this all works.
So this right here is the absolute heart of what a call option is all about. It gives you the right to buy something, but, and this is crucial, not the obligation to buy it. Think of it like putting down a non-refundable deposit on a house. You've locked in the price, which is great, but you can still just walk away if you decide against it. That flexibility, that choice, that's really the secret sauce of options. Okay, so what's that magic price you get to buy at? Well, that's what we call the strike price. It's the price that's literally written into your contract. It's fixed. So even if the market price for that stock just skyrockets, your right to buy stays locked in at that pre-agreed level. Of course, a powerful right like this isn't free. There's a cost. And the price you pay to buy the option contract, that's called the premium. You can think of it as your ticket to the ride. And here's the best part, really. This premium is the absolute maximum amount of money you can possibly lose. Your risk is completely capped right from the very beginning. Now, here's the details specific to the Indian market. You don't just buy one single option. They come bundled together in what's called a lot. So, for example, a Nifty options contract has a lot size of 75. A Bank Nifty one might be 20. This means if the premium for a Nifty option is, say, 100 rupees per unit, you're not just paying 100. You have to multiply that by the lot size, 75. So your total cost for one lot is going to be 7,500 rupees. Super important detail to remember. Right, and another thing to remember is that these contracts have a shelf life. They don't last forever. In India, you'll find weekly and monthly options, and a big day you need to circle on your calendar is almost always a Thursday. That's when most of these contracts just expire. So time is literally ticking from the moment you buy one, and that expiry date is an absolutely critical piece of the whole puzzle. Okay, so we've got the basic terms down. Now let's get into the really interesting stuff. How do you know if your option is actually in a good spot? This is where a concept called moneyness comes in. Now I know it sounds a bit strange, but it's really just a fancy way of describing where the current market price is relative to your option's strike price. So let's just break it down. If the current market price is already higher than your strike price, congratulations, your option is in the money, or ITM for short. This means it has real, actual value baked into it. Now, if the market price is below your strike, it's out of the money, or OTM. And finally, if they're both pretty much the same, we call that at the money. See? Pretty straightforward when you lay it out like that. So that begs the question, right? Why on earth would anyone buy an OTM option if it has zero intrinsic value? Well, the answer is simple. They're cheaper. A lot cheaper. But here's the catch, and it's a big one. It's kind of like buying a lottery ticket. You're betting on a big move in the market to make it pay off. If that big move never comes, well, your option can expire completely worthless. It's a classic high-risk, high-reward situation. Okay, so let's zoom out and look at the big picture. When is buying a call option the right strategy? The answer is incredibly simple. It's when you are bullish. When you believe the market or a specific stock is heading up, maybe even heading for the sky. I mean, it really is that straightforward. Buying a call option is a clear, confident bet that prices are going to rise. You're basically putting your money where your bullish view is, and you're positioning yourself perfectly to ride that upward wave if it comes. But wait, hold on a second.
It's not quite enough for the price to just go up a little bit. Remember that premium you paid, your ticket to the ride? Well, to actually make a profit, the market has to climb high enough to cover the cost of that ticket first. And this super important level, that's what we call your break-even point. And calculating it is so simple. You just take your strike price and you add the premium you paid per unit. That's it. That's your target number. Any price above that number when the option expires is pure profit in your pocket. It's such a small, easy calculation, but it has huge implications for your trade.
All right, and now we get to what is, for me, the most exciting part about buying call options, and that's the incredible risk versus reward profile. This is really the secret ingredient, the thing that makes this strategy so powerful and appealing to so many people. I mean, just look at this. Your risk, your potential loss, is strictly limited. It's capped at the premium you paid. That's it. That's the most you can ever lose. But your reward, your potential profit, well, that is theoretically unlimited. As the price goes up, your profit just keeps on climbing. There's no ceiling. It's a beautifully asymmetric, lopsided bet in your favor.
So let's put a real number on it to make it sink in. Imagine the total premium for one lot of an option cost you 5,000 rupees. Okay, that number, 5,000 rupees, is the absolute, final, maximum amount of money you can lose on this trade. Period. It doesn't matter what the market does. Your risk is defined and known right from the get-go. But hey, let's not sugarcoat it. There's a very real flip side to this. If you're wrong, if the market does not rally past your strike price by the time your option expires, then your option is toast. It becomes completely worthless, and you lose the entire premium you paid. Every single rupee. That is the trade-off you make for having that unlimited upside potential. So, let's do a super quick recap of the key takeaways. A call option? It's the right to buy at a set price. When do you use it? When you're bullish. What's your risk? It's limited to the premium you paid. And your potential reward? Unlimited. Simple as that.
And all this leaves us with a really fascinating question, doesn't it? If an out-of-the-money option has zero intrinsic value, then why does it still cost money? Why do people pay a premium for it? What is this mysterious thing called time value that gives it a price before it expires? Well, that's a topic for another day, but it's definitely something to chew on. Thanks for joining me on this deep dive into call options.